Welcome back, everyone, to the first day of the second half of 2022. And we are blessed today to have Ross Gerber, co-founder of Gerber Kawasaki. They run the ETF, ticker symbol GK. Welcome aboard, Ross. Tell us what's going on, man. Are we going to survive this? Tell me, because the first half sucked.
Wow, right? I mean, the worst first half in our lifetime, and yet you've been on vacation most of the last month, and I guarantee you it was packed wherever you went. This is like the best recession we've ever had, and like people are like, it's a recession, and they're calling me from Italy and stuff, and then they go, oh, well, the average person and this and that. And then I go down to the pier or I go to Disneyland. We even bought stock in Knott's Berry Farm because it's so packed down there. People are spending money and they're out. And so it's kind of this weird dichotomy of like markets, the Fed, and then like real life, and it's rare that you see such a big disconnect between really, really negative sentiment in the markets and really positive sentiment among people, Yeah, you don't see it in the consumer numbers, though. You don't see it in the consumer numbers.
Yeah, it's so weird. I mean, you look at like consumer spending, you see credit card spending declining, but still growing over last year. So it's like we're seeing this deceleration, but there's still positive numbers. So it's kind of like, okay, so we're shrinking, but we're shrinking off the sugar high. It's kind of like we have this like insulin response reaction of like, oh, shutting down here, crashing a little bit, but it's really we're just coming down off this stimulated high.
Exactly. And it's similar to people who use cocaine where, you if you get into this bad habit, when you go to the party, you just have this phenomenal time, right? But the party could be bad, but it doesn't matter because you're on cocaine, right? And that was kind of like 2020. Like the markets were way better than we thought they should have been or would be, but it was because of the Fed, right? And then like 2021, it just kept going, right? And so like now the Fed's like, okay, we have to go back to normal, and sorry, the party's over. And because we were on cocaine, that's twice as bad than if we were just not. And that's what I think is happening. We've seen these just extreme sentiment shifts, from positive to negative, extremely negative today,
Yeah. So what do you make for the second half? I mean, is this something where how concerned do people need to be? A lot of folks, I'm hearing this time and time again now when we've already come down, 33% on the NASDAQ. Now is when people are starting to raid their retirement funds going, you know what? I've had it. I can't take the pain anymore. This reminds me of 2008. Beginning of 2009, where my dad's like, oh my gosh, it's been a terrible stock market for 6 months. My retirement's going to be gone. I need to save what's left. I'm going to sell everything. Meanwhile, he ends up selling and capitulating at literally the bottom of the market, and he never gets back in. Never gets back in. No retirement fund, still to this day.
Right. And you'd be surprised. There's still people pissed off about the financial crisis that haven't gotten back in,
Yeah.
And that's why you need a financial advisor. That's kind of what we do at my firm. That is what we do, is like, if you're allocated correctly, you haven't been able to avoid losses here. Nobody has. So even the most conservative investors are down 15 to 20%. And in our balanced accounts, we're still down over 20%, 20% or such. And our growth is down a third, which is like crazy. So from an emotional standpoint, you'd be like, oh my God, get me out. But see, that's where a financial plan is so important, because if you look at your overall situation and you say, well, I own great companies, I have a great balance between stocks, bonds, and cash, so I'm not in any like financial risk, but emotionally, I hate seeing my accounts go down. And that's where we come in. And so here's one of the things I tell people. And this is, and I probably tell people this about 10 times a day right now. So you have to look at your money differently than what people look at their money. Okay. So what most people do is they look at the maximum amount of net worth they've ever had. Then they subtract to where they are, and they've lost this money. Okay. So they go to the maximum. Now, this is a recipe for never feeling good, because essentially, because markets do this over time, you're always up and down, because if you're not at the high of your net worth, you've lost money. That's the way people think. And it's a really weird psychology. So if you have a client, like I have a client that, let's say 5 years ago invested $5 million and it's grown to $8 million today, but it was at $10 million a year or two ago, let's say a year ago. Okay. So the client had $5 million, and this is a real story, then got to $10 million and now is at $8 million and says that they've lost $2 million.
Yep.
Is that in fact true? No. In fact, he's made $3 million over the 5-year period. Okay. Sure. And then you start doing returns and you're like, you're up 8% or 10% or whatever it may be. You see what I'm saying?
Yeah. Yep.
So the first problem most people have is the way they think about their money. It's wrong. Your net worth is not the highest point it's ever been, and now you've lost. It's where were you 10 years ago?
Sure.
How much money did you have 10 years ago? How much money did you have 5 years ago? And when I say how much money did you have before the pandemic and how much money do you have now? And people have done pretty well through the worst period of time you could ever want. Now, all the restaurants closed. All the retail stores closed. Today, you walk down Montana or you go into Santa Monica, they're all new stores and restaurants, all new. That is not a recession. So with the Fed moving interest rates back to normal and shocking the economy, essentially, there is this risk that there's a temporary recession because the Fed is too aggressive. And this is what I told your viewers, I think it was the beginning of the year, when the Fed starts raising rates after the third rate increase. This is the scary time. And that's exactly where we are now, because the question is, when does it end? Because now we see the economy turning. It's clear it's turning. Look at yields. So the yields have dropped to 286 or something today.
Yes.
This is crazy. We went from 3.5 to 286. Massive bond rally, right? I started buying bonds because we started buying bonds.
Oh, because you started buying.
Because we started doing it. Everybody else did. No, it's because it was just yield. Like when, my clients are scared to invest in the stock market, but I could go buy a bond. I bought Netflix bonds paying me 7% through the rest of the decade. That's a great yield, 7%. I bought MGM bonds paying me 7.5% through the rest of the decade. So I went out to my older clients and locked in these yields. I'm buying REITs like IIPR at 6.5% yield. And I said to clients, forget the stock market. Let's get yield now, because if there is a recession and rates do come back down and we go back to the old trend line, these yields are going to be like 1983. Okay.
Wow. Yeah.
And so, my feeling is if this is really like 1983, which is possible, then you want to buy the heck out of bonds, because when I started in the business, you had all these people who had bought bonds in the 80s who made a fortune because you could buy a treasury or a muni yielding 15%. Okay. You could buy a tax-free muni for 12% in 1985.
See, you know what you need is you got to make like the Robin Hood for bonds, man.
Well, I was thinking about, doing a whole thing and teaching people about bonds, because you can actually make a return on bonds over inflation for the first time in 15 years, right?
Yes, real returns. It's crazy.
Yeah.
So
see, bonds have been a negative return for years and years.
What's your take? Are we going to see another bottoming in the bond market then? Because, like you said, the 10-year was at 3.5. It's at 3.86, 3.88 now. It's a massive 70 basis point move in a matter of a week and a half. When we get through more of this quantitative tightening cycle and the Fed's buying less, there's less demand for these bonds. Are we going to push those yields back up? Or like, where's the market, capitulating?
Right. So we're seeing it in commodities, and like my shipping company, Zim, just getting hammered today, like shipping costs coming down, commodities costs coming down, oil prices stop going up, so now gas prices stop going up. So copper prices going down is also a signal of a weaker economy coming forward. So we have the plus side of China coming back online, and China reversing what I considered incredibly detrimental policies to now being more open about, the economy and COVID. So she had like a near death experience locking down Shanghai. So we're very confident that they're not going to lock down cities again. And that's really good, because what we're going to see in Q2, like we saw with Micron and many of the other companies that are going to report, is this was a really tough quarter for making money because of war, supply chains, China lockdowns. It was like everything that you couldn't really quantify happened in the second quarter, and that hurt markets. But as we move forward, and you kind of look at, like, if China's stimulating their economy, that's like a hugely positive thing for the global economy versus the lockdown. So I was super bearish on China, became a little bit more bullish on China. And we added BYD to the portfolio, BYDDY, which is just dominating the electric vehicle, but battery, they're making great batteries at BYD. So we added that to the fund, and we're adding that to our portfolios to add back a little to China exposure that I had dumped 100% of. And I love the EV business right now. So what's happening is just like beautiful for our portfolio, because people are now buying less gas. Gas demand is going down because the prices have gone up, and EV prices are skyrocketing. And you can now sell your Tesla for a profit. Every Tesla owner can now put their Tesla up for sale and sell it for a profit, because the demand for electric vehicles and the arbitrage between gas and electric prices is so high now that owning electric vehicles saves you $5,000 to $6,000 a year. It's become an incredible value proposition for people who drive.
Do you think that could be a reason why, and does this concern you that maybe we're seeing something like these sort of charts where, at the bottom there, at the bottom left, we've got that red line Q2 2022 estimate for Model 3 and Y orders coming in vertically substantially lower in order quantity, and the time that it takes to delivery shrinking. So kind of like delivering these faster, seeing less orders come in. Do you think that sort of that pacing is concerning compared to
where'd you get this chart?
This is Troy Teslike. He does the estimates on Twitter. And so, about 67 days into the quarter, he was estimating that our pacing for orders was the lowest that it's been out of the last 5 quarters.
No.
The red line there at the bottom.
No, I don't know if that's correct. I mean, demand at Tesla's off the charts.
That's what I thought as well.
And delivery times have extended out. And I got people calling me saying, can you call Elon and get me my car? I thought it was the opposite problem, that it's been taking longer to get a Tesla. The demand has been so high. And then they've had these supply chain issues. And if you look at the last week, Tesla, like, that's why Elon hasn't been tweeting, because he's been like probably delivering cars himself, Wow. So they've got production back full plus in China. And so they were just like, we got to try to make the quarter, and they've been pushing out cars like crazy. But Tesla, if you buy one today, it's hard to get one anytime soon. So yeah, I don't see any demand issue. I don't know where those statistics are coming from, because I also am Polestar, and we're seeing the same thing at Polestar. The demand. Oh my God, it's a dream come true, right? I mean, so who wants to spend $400 a month on gas?
Anecdotally, one of the things that I'm hearing is people are wanting to buy an EV, but then they look at the wait times for like the Tesla or whatever, and they say, whatever, I'll just buy a legacy EV just so I can have an EV. And then maybe, in 3 years, I'll buy a Tesla or something like that. Like, do you think that's actually a positive for Tesla, that maybe we're just delaying demand while we ramp up rather than destroying that demand?
No, I think it's so, like, 5% of US cars sold are EVs right now. 95% of cars are still gas guzzlers, and if you drive around LA versus, let's say, Texas, what you see is vastly different vehicles, right? Yeah. So Santa Monica, California today has more Teslas than it's like every other car. And then the rest of the cars are kind of like fuel efficient cars. And we've seen the SUVs and the Land Rovers and the Broncos start to trend down in sales. And we've seen the small cars, the fuel efficient cars. This is what happened in the 80s. So in the 70s with high inflation, the result was the Japanese car boom of the 80s, where the small fuel efficient cars became super popular in the 80s, and Japan became this massive industrial, success story because of the cars. And that's what's happening with the EVs now. So what we think, and we're seeing this at Ford, and we're seeing this at Rivian, except they can't make that many trucks, that if you can just come out with an EV, it will be sold. It will just be sold. So the issue is, can we do this profitably? Can we get our supply chains in order? And can we meet demand? And we're seeing that, like at Ford, the demand for F-150 is 100 times supply. You know what I mean?
Yeah, yeah.
And
For the
so,
EV version, the Mach version,
yeah,
yeah. And but
yeah,
what's crazy is they just came out as well, Ford, and they're like, yeah. So all of our profits from making I think it's the SUV, the Mustang Mach-E
right.
SUV, whatever,
Like,
one of those.
just,
I think it's just the Mach-E. I don't know.
yeah.
I don't pay that much attention to Ford. But anyway, the SUV one. There were reports that they wiped out all of their margin, all of their profit on those cars because of commodity costs, but they're
Yes.
selling them like crazy. They just can't do it profitably. Whereas Tesla is raising the prices and
Right.
they're still making profit while selling all of them.
So Tesla's like Apple, where it's like, we're going to make our margin and and also it's kind of like ticket scalpers. Like if Tesla sells the car for 63,000, other people are just reselling it for 70. So like Tesla doesn't make the money. This is kind of like dynamic ticket pricing, where like, you don't want Tesla scalpers. And that's basically what's happened now is there's Tesla scalpers and they're just trying to buy every EV and resell them. Like people aren't dumb, they're capitalists. So you got Hertz and the rental car companies buying all the low end EVs. Now Uber drivers finally figured out like, hey, if I don't have to pay for gas and I can still depreciate 62 cents per mile on my taxes, even though I don't pay for gas. Hello, Uber drivers. Now they're buying EVs like crazy because all of a sudden your margin doubles if you're an Uber or Lyft driver, right? And then you've got people, right, who are like, oh, so Tesla raises prices, their costs go up, and there's no problem. They could raise prices to 70,000, still sell the car because the scalpers are still selling them for 70,000, right?
It's wild,
Well, Ford just needs to raise prices, but the problem is they got the dealers, and the dealers want to make their profit, and so they're raising prices on the dealer level, and they're fighting the dealers who are just gouging the consumers, right? And they have no control over that, and so that's the problem with Ford. But many companies are dealing with this, and it's not just car companies, where sales are going up, but margins have gone down because of, and we're seeing this at Nike, for example. And this is the story of Q2. Sales will be decent, but margins will be hit. And it depends on the business. So for Netflix, probably no margin hit because they don't have to ship anything. But a lot of companies like Apple are kind of caught in this middle ground of sales in China, shipping, supply chains. It's a tough quarter for Apple.
That's really interesting that you say as well that the dealer is making the margin. And I think this is one of the things almost everybody forgets about Tesla is there's no dealer. They sell direct. So see, during the last year, and even to some degree now, you have dealers that on like the Prius put a $5,000 or $10,000 dealer markup because they can. So the dealer, like the DCH, Toyota of whatever, Oxnard or Palisades or whatever, they take the profit, but Toyota doesn't. Whereas with Tesla, you raise the price, that's your dealer markup, but it's going into Tesla's bottom line and into Tesla stock EPS, right? And their earnings per share. Now,
and that goes by the model of the antiquated model of the car companies really ceding power to the dealers for service and sales, which are the two most crucial elements, but then not really having control over what happens with pricing and who gets the profit.
Right. Now, what do you think about this idea that we'll go through a recession? We've seen multiples come down.
We're going through it right now. It's the best recession ever.
Perfect. So we've got multiples that have come down on stock valuations. We haven't yet seen the earnings recession where earnings are going down. And this is where I think exactly what you're saying, you're going to see, maybe flat sales at Nike, which year over year, Nike sales are down 1%. So you're seeing that like the flat sales. Now it's a matter of like that EPS is probably going to come down. One of the, I want to ask you what safe havens you think there are, but one of the safe havens I think in an EPS recession is actually on the topic, Tesla, because they have so much demand. You could slice their demand down by 50%, still sell more cars than you did last year.
Right. And there's many businesses that are recession proof, like Netflix, where people don't just like entertainment actually does well during recessions because we look for escapes. So Netflix and Disney, which are incredibly cheap stocks, we've been adding to. These are the two best brand names in entertainment, and they're recession proof. Now, Disney less so because of parks and resorts, but we are seeing incredible demand for parks and resorts and theaters. There's just been no change in demand, and the summer season just begun. So, once again, people are So the consumer sentiment survey, they say everything sucks. My gas prices are up, my rent's up, my food's up, and I'm unhappy. And they're saying this on their way to Disneyland to buy, $200 lifesavers and $20 hot dogs, And I'm like, dude, how can consumer sentiment be so bad? And then you go to the pier in Santa Monica and people are like fighting to get on a ride, And so, these aren't cheap things, Oh,
but is this potentially the difference of the upper middle class and upper class versus the lower class and lower middle class?
It's never been better time to be a lower income person. You know what? Minimum wage just moved up in Santa Monica to $16, and nobody's making less than $20 or $25 an hour. Nannies, dishwashers, line cooks, hospitality. The demand is still huge for labor.
Wow.
It's still huge. In fact, it's the opposite. The people getting laid off are the high-paid software developers at all these companies. Tesla threw out 200, lazy software developers. You're seeing this all over the place in tech world. The tech world's like, oh, we got work by all these people last year who basically work from home and don't do shit. And so they're just like cutting people. And you're seeing this across the high-paid sector of the workforce. But the lower-paid sector of the workforce is in enormous demand. And that's what's bullish for the economy. Okay, longer term is that we've had a secular change in sort of what the need is, and we're bringing manufacturing back to America. It is a little bit more inflationary to do this, but it creates humongous demand for labor.
This was just posted a few hours ago. Facebook has plans to cut engineers, cut plans to hire engineers by at least 30% this year, and has warned them to brace for a deep economic downturn. So on one hand, we've got a little bit of that sort of warning that you're talking about with it's the upper end getting cut.
Right.
But I also want to talk about the second part right after I mention. It's really interesting. Everyone says the lower end is the one that's getting pummeled because gas prices are up or rent prices are up. And this makes up a disproportionately large share of their income.
Correct.
But you're right. Like, wow, nannies are getting $15 pay raises on top of the $20 they used to make. Now they're making $35. It's just like, that's almost 100% pay increase, whereas like the upper middle class, maybe like pilots, for example, they had to go on strike to get a 17% pay increase just yesterday.
And we're in huge demand for pilots, right? I mean, it's like crazy. So we work with thousands of families, across the entire income spectrum, because my firm doesn't just focus on wealthy people. And so we have people from young people coming out of college to people who make lower incomes, who are great savers. But the thing that's most common about our client is that they're investors, they're savers, they're people who want to get ahead. Right. So in our society, about 50% of people, no matter what their income level, want to save money and get ahead. And they're able to do this even at lower income levels because that's what their goal is. And then 50% of people, irrelevant of their income level, because we see rich people who make tons of money and have no money because they spend it all. Okay, you see this every day. It's called basketball players, right? And so it's like you'll never meet a bunch of people who have less money at 60 years old than professional athletes, actually. So when you look at $225 million deals left and right for basketball players during the recession, right? These are the people that end up with no money, believe it or not.
Wow.
So saving and investing is a mentality irrelevant of your income. So half the people save and half the people spend. So when inflation's bad, it actually just really hurts the people in debt. Rates go higher. They don't, a lot of cases don't earn higher incomes. And then more of their income is spent on rent, food, gas, and debt. So if you have more debt, higher rates isn't good for you. You see what I'm saying? And so there is a portion of the economy and society that is going through a tougher time because of inflation. And then there's a portion of the economy and society that it's gotten more expensive and nobody cares because they're making more money. But I think Zuckerberg and Musk and the tech view of this coming recession is because they work in a digital economy. But if they were like working in the hotel business in Vegas, which we're in through MGM, and you saw the demand for Vegas right now, all these software engineers could go into hospitality and find a new job.
Wow.
But I don't think they want to do that, right? Because that's actually hard work. So, you know, like, so I think the idea that we're going to go into some sort of like deep, horrible recession is based off the concept that the Fed is unable to stop raising interest rates. Okay. So if the Fed keeps raising interest rates forever, we're going into the worst recession ever.
Yeah.
But that's not what's going to happen in an election year for sure. Actually, the Fed just needs a reason to stop raising interest rates.
Yeah.
Okay. They just need a reason. They need inflation to come down. They need a reason. And that's happening now.
Yeah, I know you're big into bonds, so this is probably my favorite thing to look at. Is I look at the break-even rates, and I'll just hide myself for a second here. We get this peak in break-even inflation rates there in March. They've come straight down to levels now where, you know, we haven't seen these inflation expectations since like October of last year. So in other words, we went through this crazy Q1 fear of inflation lasting forever, and it's plummeted. The bond market is telling us inflation is transitory. Now, nobody likes to hear that word, but that's what the bond market's saying. They're screaming it to us right now.
I think that the term transitory, we should probably just get rid of.
Stop using it. It triggers people. People love it when I say it.
It does. It's transitory for a long transition.
It's transitory for 3 years, but it's transitory.
Inflation was totally transitory if it wasn't for the war, you know, and like the war has been one of the worst things that's happened in the world in 60 years, you know, so the effects it's had on the global economy have been extreme and certainly not one to discount and just say, oh, no big deal. It's been a big deal. And that has caused enormous disruption and inflation. But what's happening now is that this war isn't going to go away quickly. And it's now a stalemate. And, you know, what's really happening is we're uniting Europe into a much better situation than we had before. And NATO is becoming this massive expansion, which may include now South Korea, Australia, Japan, and all of a sudden NATO becomes a global Asian force for good. Wow.
China's pissed about that.
China. Yeah.
China's pissed about that.
You're fucked. You're fucked. You're fucked, Xi. You just fell into the trap of creating an Axis versus allies scenario, very much like World War II. And the allies are getting together. So Russia's goal has failed miserably in dividing and conquering the world, you know?
Some would say that, if anything, you know, we've potentially now risked the dollar's reserve status as the reserve currency of the world, that we settle oil in dollars. Now China and Russia are settling it in other currencies, and
I thought
China's
Bitcoin
getting oil for 20% off.
I thought Bitcoin was the reserve currency of the world.
Yeah.
It's not Bitcoin?
No,
so you're gonna go put all your savings in Xi's bank? Come on.
No.
The dollar is the best. That's why people are buying the dollar.
All right.
There's one game in the world for sure, and it's here. If you want to play anywhere else in the world, you ain't going to make money. You're going to make money here in America, and American companies in the dollar. I think it's never been a stronger argument. America is like the freest, best country in the world by like miles, right? And we're totally dysfunctional. So like, if you know, like, so think about how bad it is in like England, you know, they got like Boris Johnson who can't even like do anything, you know, it's like
he could party.
It's like, oh, don't have a party, don't get COVID. So he goes, has a party and gets COVID. You know, that's your president. At least our president just falls off a bike, you know? So going backwards to what you were saying. So we went from like runaway inflation fear, this is the 70s, to now we're going into the worst recession, and bear down, software developers, because we're going to start laying off all you $280,000 a year guys, right? And I'm like, wait, you know, the Fed might do 50 basis points in July and call it a day. You know, who knows?
What I do know. Okay.
They have no incentive to create a recession if inflation expectations decline.
Which they're plummeting. Yeah, exactly. It's crazy.
Right? So now they've created the perception of a recession, and everything changes. And now they've got the cover before the election to then say, we're going to see how this works out. And then boom, That's when we get our money back.
It's funny you say that. Jerome Powell commented just 2 days ago when he was testifying in Congress, maybe 3 days ago. I think it was Tuesday. And he's like, it's great. The market basically does our job for us.
Right. Yeah. Which is not the way they're supposed to do it, which is what screwed us in Q1 and 2.
Sure.
Is that the Fed basically was behind the curve.
Yeah, right, I don't think they have the confidence in their own actions. So it's like if they can just come out and every week they've got a schedule of people yapping. Inflation's the worst thing ever. Forget dual mandate. Inflation's the only mandate. And the market freaks out and prices in the rate hikes. Basically, the Fed just moves their lips. And they
instead of actual actions. That's exactly what happened, Kevin. And that's exactly why we misjudged the severity of the first half of the year, because typically the Fed just raises rates when they're supposed to, does it in an orderly fashion, and they don't have to talk up long rates. The short rates does the job, and they kind of march up together. And that's why you have a little bit of cover for a few rate hikes before things get dicey. Okay, what the Fed did here was they're like, we're behind the curve. Let's just talk up the 10-year because we're behind. And the 10-year goes from 1.6 to 3.5 and stocks just collapse. So that's not surprising, actually, because like if you look at mortgage rates, like I want to talk about real estate for a minute because, I am actually buying my house.
I do want to hit on real estate.
Come on.
Let me quickly throw this in.
So anyways, that increase is a big deal.
Because we're still somewhat close to Tesla, before we get to real estate, if you don't mind, I got to show you this. Okay. So I tweeted this in September. It says, do not buy a Tesla, buy Tesla. That was in September of, it's kind of cut off there. There we go. Right. Do not buy a Tesla, buy Tesla. Right. Well, that didn't age too well. You would have probably been up about 15% right now if you bought the car, and you'd 25. Be down like 15% or whatever from there if you bought the stock. Now, what's funny about this is you actually replied to this with just question mark.
Yeah.
So I had to bring that up, man. It's like, usually.
Well, I tweeted that yesterday that if you would have put all your money in Tesla cars instead of Tesla stock in January, you'd be up 25% on the year.
That's what I'm saying. It's like, in what twisted world is what I wrote there wrong? But it was.
Listen. Anybody who's selling Tesla stock to people right now at $700 is giving you a gift. It's just giving you a gift, because one of the things I'm sure of in 29 years of doing this business is that most investors can only remember 12 months ago. They just can't remember the past. They just can't remember. It's unbelievable. They don't remember. So it's like, oh, Tesla has this problem. Oh, now Tesla's ramping 2 factories. So yes, expenses will be much higher this quarter. Hello, that's ramp. So the analysts are going to go out and say blah, 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 blah. But they don't remember the ramps of the previous years. Of course, it's more expensive in the first 6 months. But when we get out to December and we got 4 EV factories just humming, and you start counting that we're going to do 2 million cars, it's like, that's all that matters. So you own a company. And another thing I've been telling clients about 10 times a day is that if you buy private equity, if you buy into like any private company, nobody values the company more than once a year. Okay. Yeah. So like I have private equity investments, and like I put in $100,000. It just says $100,000 on my balance sheet because I don't even know what it's worth. Exactly. And there's nothing to look at. There's no stock price to look at. It's like I own probably 4 or 5 private companies where it's like, I haven't checked the value. I don't know how to check the value. My 401k, for example, at work, our interface is so poor because 401k interfaces suck most of the time, so that people just don't check it very often, because it's like, why? And it's like, I finally looked at it the other day and I was like, oh, I'm down 20% of my 401k. But I actually hadn't thought about it at all because I just didn't look at it. But I put money into it every month. And so it doesn't matter to me if I can buy the greatest companies in the world cheaper. That's a huge advantage as long as this isn't the financial crisis. And it's not. Banks are in the best position because banks are in the best financial position they've ever been in. And in fact, the banks just recently got the Fed to say you can pay dividends, you can buy back stock, you can do what you've never been more profitable. And now rates are higher, so they're just printing money. Nobody said, Ross, we don't want to give you a 5% mortgage. They couldn't wait to give me a 5% mortgage. They haven't got 5% on a mortgage in 15 years. Okay. Now rates are coming down. And I said, are you lowering it? And they're like, oh, I don't think so.
So
I
tell
go,
me
it's
about
not
this.
locked. It's not locked.
Tell me about. Oh no. Okay, so you're buying a place. Tell me about this.
Well, I'm buying the place I'm renting. So, I've been renting this house for 4 years, and my landlord's like, I'll never sell it. I'll never sell it. The owner of the house. You can't buy property in the Palisades. And this is a big property. It's 15,000 square feet of land, and it's on a river. So in LA, that doesn't exist. So he's like, I'm not selling, because nobody sells their houses here unless they die. And that's how he got this house, was the person died. So, so real estate changes, rates go up. This guy does real estate. That's what he does. And he panics. And he's just like, so the neighbor's house sold 2 houses down. And he was just like, if you pay me what the neighbors just got, I'll sell the house. And my wife's like, what? Did you hit your head? We've been asking you this for 4 years, And it was like, I don't know. He said, send me an offer by, like tomorrow, or else I might change my mind. And we were like, boom. And now I'm in escrow, and I'm like paying the highest price ever for a house in the Palisades. But it's like, you just can't find another house.
Wow. And you're very excited.
I'm not excited at all. My wife is excited, which then I like paying rent. My rent is cheaper. So now my cost of living goes up $100,000 because of interest rates.
Oh, yeah. Yeah.
Yeah.
Now, are you going to go variable, or are you going to go fixed?
I owe 7 years.
Okay. Interest only, 7 years. That's awesome.
Yeah.
Increase your buying power in stocks during a time when they're on sale.
Well, this is what I'm pissed about, because I was hoping to just renew my lease, and I had all this cash for the down payment. And I was like, honey, I could put a lot of money into Tesla right now, and we could buy like 6 houses when that works out,
Yeah.
But that's not the way life works. That's why financial planning is financial planning. I have a family. We don't want to move. The guy's going to put it for sale if we don't buy it, And so it's like, sometimes the best opportunity is making your family happy. And I'm going to develop this property at some point, and I'll make millions of dollars when I do that. I'm not excited to do it. It's not what I like to do, but life just is what it is. So I have a wonderful place to live, and now we're going to buy it. And so I'm in
one of the best ways to submit like plans for renovations or construction or whatever. One of the best ways I found is doing it while either you're living there or a tenant's living there.
Right.
Because if the city jerks you around for an extra 2 months, doesn't matter. You're not losing rent, But if you have a vacant property you're trying to develop, don't even bother in California, man.
No, it's a nightmare. That's kind of the advantage, is because we live here, we can apply for permits and
take your time.
We're living here either way, they're building everywhere around us. So it's like, we're going to have to build to get value out of, because we're paying a high price, but it's supply and demand. And that's why I think you were tweeting about like real estate going down, and I think real estate will go down in many markets, but I think in many markets it will not too, just because of supply and demand. So I think in the overheated markets, where like Austin, where everything just got bid up to California prices because everybody was moving there and work from home and this and that, those markets I think are somewhat vulnerable to rates. But when you look at like the Palisades, where there's just so much demand, like multiple bids are still happening on every property, because we live on the beach in one of the best places that's not impacted by fire risk. And so if you're going to buy a property, you want to think about fire risk in California. And there's very, very few places that don't have fire risk. And that's what makes these houses so valuable.
Yeah, what's great too, and people get mad at me when I say it, but a lot of people are like, oh my gosh, how could you invest in California real estate? And one of the beautiful things is California has such a massive shortage of homes. Right. And the politicians are so dumb with their inability to actually build more homes that you're actually investing in an asset that becomes more valuable simply by the fact that California is refusing to build enough homes. It's like,
that's exactly
if you had to pick a state out of all 50 states and go, which state is the hardest to build homes in? It's California.
Oh yeah.
And that's
It's
where I want to
insane.
buy.
Well, but I don't even look at it as you're like buying a home. I look at it as like a membership fee. And so it's like, there's no, like, you can't like quantify why it costs so much to live in California. It's like, costs this much to build a house, costs this much to buy land. Why would I pay 2x that just to live in California? That's the membership fee. So we pay a membership fee, and we pay it for a reason, because today it's absolutely beautiful anywhere near the coast in California, right? It's perfect. But in Austin, or I would say 80% of the country, it's uninhabitable because it's so hot and it's humid and the bugs and the this and the that. So everybody loves Austin, but they don't spend the summer in Austin. California is wonderful in the summer, and they're all here right now. Let me tell you, okay? The tourism here is insane. So they talk smack and they talk smack, and then they fly here and pay really expensive hotel prices, right? And that's why I'm like, this is the best recession I've ever seen, because Disneyland is packed today. Packed. Don't go. Oh my God.
So are you, tell me more about consumer discretionary. So since January, we've been, worried about certainly e-commerce, right? The Etsy's, the Amazons, right? What e-commerce has gotten whacked, and Shopify, and that's all turned out to be true. Like those have gotten hit.
Yeah. I mean,
but now we've got, with that, we've also seen big discounts in like the Netflix and Disney's, but these are seem a little bit more sticky, and they also have the Disney element of the theme parks. I think people are dramatically undervaluing how much money people spend at these theme parks. People are spending per person, per head, per capita. They're spending 50% more in theme parks than they did in 2019. So that means, twice. Well, for every 2 people, it's twice as many hot dogs. It's crazy.
Well, we're seeing it in concerts too. We're seeing it in our music businesses too. I mean, we were shut down 2 years ago. Everybody's losing money. Now we're adding shows and everything's selling out.
So where do you think the better discretionary investment is? Do you go back into Etsy at 50% off, or do you go into Disney?
Yeah. So look at it this way. So during pandemic, companies that were focused online had this wonderful benefit and made a lot of money, and valuations grew substantially. And a lot of these companies like Shopify, really benefited. So now we're getting back to normal, and normal is that we go out and we shop and we like doing stuff, and Amazon gets less use and Etsy gets less use. And there's nothing wrong with these companies, but they just come back down to earth. And so the omni-channel businesses like Nike, where you can buy online or you can go to a store, are a better business model longer term, like Ulta salons, wonderful business model. But the pure online player, like Pinterest, just lost their CEO and founder. They haven't been able to monetize a nice platform for a long time. But when you think about, they've had all this time to make smart, strategic decisions, and instead they sort of just keep riding their business down the same path. And then things change back, and they just haven't adopted. And so they'll go through this lull, and then they'll find their valuations. But maybe these businesses have peaked, like Yelp is a perfect example of a business like that. It's peaked years ago, and they have done nothing. It's still a good service, actually, but it's just, where does it fit in the world? I don't need to invest in that, And I think that's where Kathy Wood is mistaken with the Zooms and the Roku as her top holdings. Is I'm like, I like Zoom, but is Zoom ever going to be better? Is Zoom ever going to be more popular than it was 2 years ago? And the answer is no. And quite frankly, I use Teams, and Teams is great, and Zoom is great. But like, do I want to own that? I just don't know, because the next stage is like what people are actually doing, and they're going back to theaters, for example. And so a company like Disney benefits from the rise in theaters. They literally lost billions of dollars in revenue because the theaters were shut down. And now theaters are open, and they got movies coming out. They got a Marvel movie that just did well. They got Thor coming out, and all of a sudden they start making hundreds of millions of dollars a year in the movie business. So companies like Disney, which have physical businesses, but also did well in the pandemic because of Disney Plus, they're going to see Disney Plus kind of like stagnate. But there are other more profitable businesses will explode. And that's
Yeah.
what investors are going to have to look at is actual earnings per share. And if you look at earnings per share for a company like Disney, we expect it to grow rapidly over the next 2 or 3 years.
For a company like Zoom, I was trying to find it. I was playing around in their last quarterly report, and one of the things, and they don't break it out very clearly, but one of the things that it seems like at least they're trying to transition to is this idea of creating Zoom offices and then leasing businesses the TV, the conferencing phone, the VoIP service, and all of this, basically making these Zoom rooms for companies, and then not only getting the subscription revenue from that, but also getting a return on the hardware. Do you think that's a business that is intriguing to you?
Not at all. It's capital intensive. And I was just in an office the other day because you know how offices are sort of evolving. And we've been kind of on the forefront of it because I'm not really a work from home advocate. I think hybrid workspaces make sense where we prefer people to come in at least 3 days a week in the office. I do usually 4 days a week in the office, maybe 1 or 2 days out of the office. But the idea is we need more rooms for video calls because it's still super efficient to do video calls, right? So I saw this office and they had these like little, like almost like phone booths that they put in the office for Zoom calls and stuff. And it was like really, really cool. But like Zoom works really well on a phone or works really well on a laptop. And all my employees have, 5G phones and Apple laptops. So they don't really need equipment. They just need somewhere quiet to do the call. And so I don't want to be in the WeWork business. I don't want to be in the office space business. I don't want to be involved with offices in any way. I don't want to own office buildings. That is not the future. The future is the hybrid workspace where companies, depending on the industry, will have various different types of models for their employees. And it will be very different among different companies, even within the same industries probably. But this is not a place, if I'm Zoom, that I want to go because I don't want to go into capital intensive businesses if I'm a capital light business like Zoom. I think Zoom clearly, they're trying to sell more services to people. They just haven't been successful. That's because of Microsoft. And we own a lot of Microsoft. And I think Microsoft is one of the best companies in the world because they integrated Teams into the 365 experience so quickly and so well that it's just, I use Microsoft 365, so it's just easy to use Teams. Now we use Zoom at our firm, but I use Teams almost as much as I use Zoom because other people use Teams,
Right.
But Microsoft's making money every month on the subscription revenue for everything else, not to mention they're in gaming, which I want to be in big time with Activision and Xbox. But I think Zoom ultimately is a great company that it was a pandemic winner, but over the next 5 or 10 years, I think a lot of that, Zooming is behind us,
What do you think about the Activision arbitrage play? I think it's supposed to close at $96 or something like that, or $92 somewhere around there, and it's trading for 78 right now.
Yeah, it's like my Twitter arbitrage play where it's supposed to close at $54 and nobody believes Elon's going to buy the company. I think there's probably, they each have different risks. So the risk with Twitter, you'll know in 2 months because he's trying to finish this merger in 2 months. So the Twitter result, you can make a very good return in 2 months if he buys the company, which I think he is. With Activision, you have antitrust issues, you've got government oversight issues, you got workplace issues, EEOC investigations. So Microsoft management's going through this like really painful process of trying to get this merger done. And it looks like it's going to be somewhere in the middle of next year. So part of the arbitrage trade is like, when will this be completed and what's my return over time offset by the risk that the deal might not go through because of the government or something like that. And so to me, there's still like a year before this is going to be done. And so because stocks are so cheap, the risk reward, you could buy other stocks like Tesla, for example. I think the risk reward is much better than that because Activision was such a troubled company. Now, on the other hand, I do think the deal will go through. And I think that will be something to look at next year.
What are your favorite stocks right now? If you had to pick 10, 5 to 10.
So look at it this way. You have extremely undervalued stocks in one camp. Like it doesn't matter what business they're just like way too cheap, right?
Okay.
And then you have what we do mostly, which are thematic stocks, which themes are really benefiting the most from the current environment. So in my mind, this is the EV point that I've been waiting for a long time. This is the shock that society is feeling, the pain of owning gas cars. And there has never been more incentive to buy an EV. So when you think about what you want to own and where the future lies and where there's growth and so much opportunity globally, the clean energy EV businesses that we own are just phenomenal investments. That's Core Holdings in GK. It's about 23% of our fund is in this. About 26% is in technology companies. So I like EV tech way more than traditional tech. Okay. That's why we just added BYD. Polestar here at $9 is just ridiculously cheap. Arcimoto at $3 or whatever. It's cheap. Okay. You've got Next Era, Sun Power. Solar Edge is a company I like a lot. Okay. And then in commodities, MP, which has gotten cheap. It's like the battery situation hasn't changed. So I added BYD for their batteries and EV production. And then MP is a recent addition for the commodities. And they make rare earths here in the United States that are critically important for EV motors. And they're expanding rapidly. And we're looking at adding SQM, which is also a lithium commodity player in Chile. But because commodity prices have coming down, these stocks have come down, and now you have the opportunity to get into the commodities players. So we're invested from commodities to EVs and solar panels through our system. And I don't think there's been a better time to look at alternative energy and what are our things, because ultimately just pumping more oil isn't the solution for the cutting Russia out of the commodities market. Ultimately, we need to stop buying oil from Russia, Iran, Saudi Arabia, Venezuela. I mean, it's like the list of horrible country governments is all we fund. And so clean energy isn't just about what's great for the environment. It's also what's great for humans. It's great for our society. So all these things have finally, this is like that huge moment, cathartic moment where if we don't really accelerate this, it's really going to be bad for our society longer term. And I think that's what's going to happen. So that's one of my favorite places to invest. Right.
Any thoughts on potentially, the Supreme Court just had a big ruling on EPA's ability to regulate and kind of gave a little bit more freedom to oil and natural gas producers with their energy emissions. Do you think this is good for at home, like for us producing more domestically, maybe?
So the Supreme Court, and I'm going to say the illegally constructed Supreme Court, because clearly many of the justices perjured themselves during their testimony to be appointed, as well as at least one or two justices are completely illegitimate. Clarence Thomas and Amy Coney Barrett should not be there and do not represent the type of integrity level that Supreme Court justices should have. So let's just say that the court, in essence, is an illegal court. Now, once we get past that, the court has basically decided that states' rights supersede all federal rights. Now, this is not a correct interpretation of federalism under Jefferson. It's not really a correct interpretation of the Constitution, because federal law, like for environment, for example, if Virginia wants to do a lot more coal, well, that pollution affects states around Virginia. So it is an interstate issue. The pollution that Virginia creates doesn't just stay in Virginia. And that's the way it should be, right? So if you vote that you're going to do coal and gas, then we should put like some sort of like air wall around you and say, you got to breathe this fucking air that you're putting out. But instead it floats on over to states that don't want coal. So that's why it's a federally regulated thing. Okay. Like interstate commerce is federally regulated. That's why pot companies have to have a store in each state, So if this is in fact what's going to happen, is that half the states are going to make it super restrictive to do any sort of oil and gas development. And the other half of the states are like, hey, do what you want, just pay us. Okay. And then what you get is this really weird dichotomy of policies depending on where you live. So if you live in Texas, for example, or West Virginia, You cannot get an abortion. You can buy machine guns. You can pollute the environment. You can do whatever you want in your state, no matter how bad it is for everybody, because the state's right. And you can go live in that state and you can deal with all the problems associated with that state. But when you live in California, I think our values represent many of the citizens who live here, and our laws are going to do the same thing. So we're going to pass a gun law, which we just passed, that says if somebody shoots somebody in California, the gun companies can be sued now for this violence. So it works both ways, because we're actually the biggest place in the United States. It's California, the 5th largest economy in the world. So when you think about it now, all these same companies that are like, yay, yay. Well, it's going to be real bad for them in California when they get sued. Because then the Supreme Court's got to say, well, we have to uphold California's right to make its laws and enforce its laws, because that's the precedence that we've set now, that federal law won't supersede any state law, no matter how detrimental it is for everybody else. And so we're going to have freedoms in California that won't be the same in other places. And we should look at every state like a separate country now. And people from California should really consider who they're doing business with and where they're traveling and spending money, because essentially they're supporting rogue states that don't actually agree with the ideologies of many of the tourists that come there. And they will only change when it affects them financially. So we should boycott all oil producing states that have standards where pollution is what's more important to them than climate.
Now, do you think that's potentially that there's any kind of like anti sort of capitalistic element of like suing gun owner or gun manufacturers, for example, for the decisions of private individuals?
No, I look at it the exact opposite. Okay. Nobody's capitalized more than gun companies from what's happened over the last 5 years. Gun sales are at all-time highs. We have more guns in our society today than any society in the history of human existence. Okay. So capitalism would say that these are companies that are underregulated and out of control, considering how many people are being shot. Now, you're a YouTuber. I'm a financial advisor. We don't sell poison. Okay. There are companies that sell poison. They're called cigarette companies. Mm-hmm. It's poison. We all know it. Okay. They're trying to regulate nicotine now, and just like enough. People are so addicted to this poison, they can't even stop, right? There are companies like Juul that are being banned right now that are perfectly happy to get our kids addicted to nicotine again. Every day, oil companies wake up and they don't care how many people die because of climate change. They just don't care. There's this whole swath of society. Actually, the entire Live Golf Tour are people who have no moral backing at all and literally will play golf at a club where 9/11 victims are protesting them. They'll walk by Americans who lost their loved ones in 9/11 to go take a check from the fucking terrorists. It's unbelievable, these people. So we have a society that money is much more important than any ethical backdrop, led by their President Trump. Okay? And this is very detrimental to our country longer term, and we need to address this greed. We just
Are you buying the dip on ammo stock?
No.
No.
What I think is the best place to invest are where you see people doing stuff. Like Callaway Golf. Golf has become incredibly popular among all types of people. Callaway bought this company called Top Golf in the pandemic. Top Golf is the funnest way to play golf in 100 years. Like young people, Top Golf is sold out every day. Okay. And events, and they're selling apparel, and they're selling clubs, and everybody's golfing. You can't get a tee time anywhere in California. Anywhere. And now we don't even have water, and they're telling the golf courses they can't use water. It's going to be even harder to get a tee time. Okay.
Wow.
So golf is exploding, and the consumer's buying golfing products. Callaway's a $20 stock. It was as high as $35. It's a great business. We know it well. And there's only a few in the golf industry, and we think golf as an outdoor sport will continue to thrive post-pandemic.
So now for an individual, what's the best thing that you think, not financial advice for them, but just sort of in general, do you think that now's the time to be buying the dip, or is it, let's stay cash heavy, 50% cash, bunker down,
Right.
pay off debt? I mean, pay off debt should be basic for anybody, but what's your thought on sort of generic, non-personal input on what people should be thinking about?
Well, this is YouTube, so the average user is probably younger than a typical person in our society. And so if you're younger, you should just be happy. Okay, you have very low unemployment. The most important thing to you should be your job. So if you got a job, you probably recently got a raise, or you should ask for a raise, right? Or you got more benefits, you got 401k. So what we teach our clients at our firm is not to worry about it. Just like your 401k, you work each month and you save 10 to 20% of your income a month. Okay. That's what we recommend. Anywhere between 10 to 20% of your income you should save every month. The younger you are, the more you should put into equities. Now, if I'm in my 20s and 30s right now, and I have my job and I'm working and I'm saving 10, 20% of my money, I would put 100% in equities right now. I would just be piling into equities right now. Okay. A safer investor, what we recommend is what we call a balanced fund. There are many different balanced funds that you can buy at all the mutual fund companies. And balanced funds are typically 60 or 70% stocks, 30 to 40% bonds. And it's a safer, smoother ride than just going into growth with your money each month. But because of the volatility and because stocks are so cheap, if I dollar cost average, if I save each month into equities, or like my fund, a growth fund, or any growth fund, or the index like the NASDAQ, for example, if I just do that every month forever, then it doesn't really matter what the stock market does. You see what I'm saying? So what we teach clients is if you're accumulating assets, you just want to worry about saving and investing each month and keeping your job and doing well, because over time that just works. So in times like this is ideal. So if you have a good job, you want to be plowing into your 401k right now. Growth.
How much should people be concerned about job loss and if we do go through a recession here? Let's say they're in tech and they're watching, and like, how much should they actually be worried about their job?
I think that they're trying to make you worry more about your job than you should be, because that will slow the economy. Okay. You're not going to lose your job on the lower side of the income ladder. I mean, the demand, you can walk down the street and see the wanted signs still for basic jobs. I think a lot of people who benefited greatly in the pandemic financially, like in the software industry, these companies got big and bloated, and there's going to be turnover. Okay. As these companies now resize and sort of get to the right level of demand and supply. But those people will find new jobs. They're college educated people. There's tons of demand in other companies, and they'll just, you have churn. It's churn. So it creates insecurity. Like Netflix fires, 300 or 400 people. Coinbase fires 20% of their people. But these are people who can easily get other jobs. Many companies are still hiring. And we've seen this with crypto, with many of the financial players coming in and just acquiring, just flat out just acquire some of these crypto guys that are suffering right now.
Well, yeah, let's talk about exactly.
So your job security is 100% related to how well your companies run, how conservative your companies run. So nobody at my company is worrying about job losses.
Okay.
We had a record 6 months. To be honest, we had a record 6 months. Our revenue was at an all-time high. Now,
congratulations.
Thanks. It's going to be affected in the next 6 months because obviously we lost a certain amount of assets. But compared to last year, we're still doing great. I don't know.
So what do you think? I mean, in the crypto world, we've basically got this unofficial Fed called Sam Bankman-Fried, who co-founded.
Where did he come from?
It came from a lot of venture capital fundraising over at FTX, and they are plowing money, or he is, into bailing out other companies like BlockFi and Voyager, these companies that went crazy lending money to try to make a spread by lending it to somebody for, borrowing it for 8% and lending it for 17%, and then obviously stuff's collapsing. How much further does this collapse? And at what point do you think we have a further risk to maybe some of the dollar-backed stablecoins.
Yeah, there's people shorting these dollar packs, stable coins. I think the term stable coin is an oxymoron and should not be used. They are not stable coins. They are high-risk coins that have the perception of stability. Okay, so let's not be confused, boys and girls. Okay, if a crypto guy calls it stable, it's not stable. Okay, so I think I've been doing crypto for a long time, and I think the idea that you're going to give some South Korean 30-year-old $14 billion to run a stable coin, and he lives in a little apartment, and he's never done anything in finance, and he just made up Luna and all this crap, and you think some guy can manage $14 billion correctly for people. That is the biggest joke I've ever heard. Now, I manage $2 billion, and I have 48 employees, and I've been doing it for 29 years, and there isn't a day that it isn't fucking challenging as hell, including yesterday. I had all these problems with my fault, just trading issues, just fucking trading for thousands of people, and then mistakes get made somewhere. And we make people whole if there's a mistake. But it is freaking so hard running a financial institution correctly and honestly. It's the biggest challenge of my life. I can't tell you how hard it is. And yesterday I was like, I can't, if I have another meeting with a lawyer, I'm going to fucking freak out. Excuse my language. But that's where you spend half your time, just dealing with risk and this and that, because we do things right. But when you think about the crypto industry, that's brand new, it's 12 years old or whatever, 15 years old, and a bunch of people with no financial backgrounds, all of a sudden with billions of dollars they're responsible for, and you're at all surprised that they screw this up and lose your money or have it stolen. Come on. So, just read about the banks in like 1890. Read about like banks in the United States in 1890. It's the same thing.
Yeah. So do you think that the bottom's in for crypto, or could there be more pain? Is this just the beginning?
There's no bottom in crypto. Remember, it's not a stock. It's a currency. So the more users who buy into it, the more valuable it is. The less users that buy into it, the less valuable it is. Okay. We only own Bitcoin and Ethereum at my firm for clients. And there's a reason for this, because I've gone through this over and over and over again. And the lesson I learned is these will come back, because people will readapt Bitcoin and Ethereum again once they feel more confident again. And that'll probably be around the halving. So one of the things I've learned about Bitcoin is Bitcoin goes up when supply goes down, and that's in the halving, and that's every 4 years. I think that was about 2 or 3 years ago was the last halving, and that's when Bitcoin rallied the last time. It took about 6 months for the Bitcoin market to finally realize there was half as many Bitcoin being made, and then it jumped right to 60,000. Now it's back down to 20,000. And I don't know, maybe you can Google it. I think the halving comes up again in
May 24.
May 24. So that's really when you get your rally. And that's just supply and demand. You cut the supply in half, and it just has to go up 2x. So be patient, hold your crypto, accumulate. Same idea. I buy a dollar cost average. It's just part of my life. I save money. I buy a little crypto. I buy my stocks. That's what you do.
So you're okay with the BTC and the ETH, but you're cautious about the stable coins.
No, it's not cautious. I don't own any of this. I highly recommend you sell all of it. You should not own any other crypto than Bitcoin and Ethereum at this point. It is a very dangerous time. It is a time where, remember, the people in my business want to crush these people, and they're shorting these stable coins right now. And what happens, and I've done this many times, is they have a lot of capital. And remember, the whole Bitcoin market's $1 trillion. So big funds can really hurt crypto. And so they just start selling these stable coins and shorting it. And they just put more and more pressure on the system. And if these guys don't run it right, it collapses. And that's what they're hoping to do to all the stable coins right now. So if you're in Tether, you better get the hell out of this stuff. Get out. They're not safe. Okay, I have clients call me up and say, I want to put, 250,000 cash in an investment account with you guys. Is it safe? And do you have FDIC? And I said, yes, we have FDIC cash coverage on the cash accounts at our firm. And this is crucial to a lot of investors, especially older people, because there were times when banks went under a lot. One time, 12 years ago, right? And so 14 years ago. So US banks can go under, banks can go under. So don't be surprised that crypto companies go under. These are the highest risk things you can do. So get your money out of this stuff, be safe, own your Bitcoin and put it away in your back pocket. And it's a currency.
So last question I have for you, because I know you have to run here shortly, is what do you think about, we're going to have an Ethereum merge date. Maybe it comes between August and September, maybe, or it doesn't. It gets delayed again. Right. But when that comes, about 6 months after that, we expect people are going to be able to sell their staked Ethereum. We'll have this massive Ethereum lockup where you could do a partial withdrawal or full withdrawal and no longer be a validator. Do you think there's a risk of flooding the market with Ethereum?
Wow. I mean, now you're getting into sort of like complex investment strategies based off things that may or may not happen. Yeah, I think that's a legitimate risk. I mean, obviously, once again, we don't really understand fully the implications of many of the actions being taken because these are newer inventions. And so if they switch like they are planning, what will be the byproduct of this? And one thing I'm sure of is people will self-enrich themselves in crypto. If you hang out with crypto people who've been self-enriched through this wonderful process where they've been able to create their own money and take it from you, you'll realize that these are not the nicest people in the world. These are people who are very much into taking your money. And you have to be very concerned. So when I was a kid, I learned this lesson. And see, the difference between my generation and yours is we don't trust anybody. See, your generation trusts everybody. You'll get in an Uber with some random driver to your Airbnb at a random home. You'll order food from a random restaurant that isn't even a restaurant. It's like a ghost kitchen. You don't even know what's in it. You guys will do anything. Somebody tells you to walk down the street, it's safe. You just believe them. That's millennials. But Gen X, we grew up like, I don't believe anything you're saying. So it's just a different thing. Like I get in an Uber, I'm like, can this guy drive? Like I wouldn't even get in a regular Uber. And I'm like, I don't even trust this guy. Like my wife won't even take an Uber. I was like, let's just do full self-driving. I would rather do that than an Uber at this point, Yeah.
I don't blame you. I think we've, in the last month here, even in Ventura, we've been in 4 Ubers. Every single one. It's either cutting people off, speeding. It's like, what is this? I mean, I was in like New York. I didn't have that problem. I don't know what it is about over here.
You can't go fast in New York. You can't go more than 2 miles per
That's
hour.
True.
But yeah, it's, full self-driving is good enough now. It's better than I'd say 75% of Uber drivers.
Yeah. Wow.
Yeah. But I think you should be, if you're in the crypto markets, you should be very distrustful of everything you're doing and for good reason. And, it's like this NFT fad that has come and gone very quickly. Like people are still holding on to these Bored Apes for 100,000 in hopes that they'll be worth something.
Yeah.
And people are like, well, I bought my Bored Ape for $3,000 and it's still worth 100. So look at how smart I am. I go, no, you're only smart when you sell that Bored Ape to an idiot. Okay. But I look at these projects and I laugh. I literally laugh because I grew up as a trader in the 90s and I did Beanie Babies, And so it was like, so the Beanie Babies end badly and that's what's going to happen. And that's how the cycle's working, the Fed's working, the markets are working, life's working. That's the real reality is there's no easy money in the stock market. There's no easy money in the crypto market. When Dave Portnoy comes up and says stocks always go up, you know what? He's right. Except for these periods of time that really test you. Because if it was that easy, guys like Portnoy would be rich. But instead, he's lost all his money because he put it all in DraftKings and Penn Gaming stock at the high, put it all at Bitcoin at the high. He's Mr. Talk. But I'm like, investing is actually, you got to do it when it's real hard, like now.
Yep. Yeah, I agree. I think that's a great place to end it. Ross, tell us about your company.
Well, our company is very busy. It's Gerber Kawasaki Wealth Investment Management. And once again, we're financial advisors first. So if you need help getting your financial plan in order, if you're stressed about the markets, if you're wondering where the best opportunities, come talk to us. You can find us at gerberkawasaki.com. Send us an email. We work with people of all income and asset levels. We've got a program. And then, of course, our ETF GK, which is the growth section of our investment portfolio. And it's focused around really three main areas. If you break it down: technology, clean energy, and the consumer. We have a lot of businesses related to that, whether it be in cannabis or Petco or Callaway. So GK is the ticker. So the best thing you can do really is work with one of our financial advisors. Let's get your house in order. Let's get you prepared to profit from this amazing opportunity. So that's what I want to leave you. As difficult as the time this has been, and it's been super horrible even for me. It's like I'm not immune. You know, we're responsible for a lot of money, and it's super hard when there's really not a lot we could have done to prevent losses. But at the same respect, this is where the opportunity lies. And if we can just think out a year from now, if we just think out where we'll be next summer, okay, will we have all these same issues be the issues? Or will the Fed be lowering rates and markets, you know, start to come back and da-da-da-da? So that's why I've told you on the show many times, we don't try to time the markets, and we don't know when they're going to turn. I suspect it's sometime this quarter. Okay. I suspect, but I don't know. So I just buy, like what I've been doing is I've been buying my fund every week. I buy 1,000 shares a week. I just do it every week. I started, I think 5-6 weeks ago when I thought the market was real bad, when I was in real pain. That's when I started buying, you know, it's sort of a contrary indicator. And I just buy a little every week, and I'm going to keep doing that for the rest of the year with my goal to look back in a year, so next July, and say, how will I have done? And so the meeting I'm about to give my team is, although the investors that started with us last year have some of the worst returns we've ever had over 1 year, the investors that start with us this year are going to probably have the best returns over 1 year.
Yeah, you're probably right.
So keep that in mind. And if you're a client that started with us in the last year and you're down, I'm sorry, we're doing our best, but it's been 1 year. And unfortunately, you started at one of the hardest years. But what that means is the next 5 could be amazing. We're going to make back the money, and we're going to make a lot more over the next 5 years. So I think for investors, you got to think long term. You got to look at the opportunities and what's really around you, and you got to be able to just keep buying when stocks are down. But the only way you can do that is by having a systematic process.
Ross, ticker symbol GK, gerberkawasaki.com. Thank you so much for coming back. I hope to have you back again soon.
Yes, great to see you, Kevin. I always love being on the show, and great to see you again.
Awesome. Thanks. For everybody else, if you found this video helpful, consider sharing the video.